PayPal's got some major changes going on, okay? So, looking at PayPal's numbers here, total payment volume, TPV, was up 9%. Now, that's a good number, but not a great number. And I'll show you exactly why that number is not great. Know up 6% year over year. Good number, not a great number for PayPal. And I'll show you the details. You gotta know where to look when it comes to these financial reports to find out what's really going on here. And I'll show you that in this video. Transaction margin dollar up 8% year over year. That's phenomenal. If you ever see that transaction margin dollar outstripping the growth rate of revenue, that's a very positive sign for PayPal, okay? If we look at transaction margin X interest on customer balances, and that was up 6%, so basically the same percentage as revenue. Non-GAAP EPS was up 22%. Free cash flow up a whopping 31% year over year. Alex Chriss, the president and CEO of the company, he said, PayPal had a highly productive third quarter. We made good progress on our continued transformation while delivering strong operating and financial results. We brought multiple innovations to market, coupled with a significant new marketing campaign, and we are seeing encouraging early adoption. That's great. And we continue to forge important partnerships with leaders in global commerce, including Fiserv, Adyen, Amazon, Global Payments, and Shopify. Thank you to the entire PayPal team for all that you do for our customers. As we enter the holiday shopping season, we're working hard to create the best shopping experience for consumers to help merchants win every sale. The focus and drive across the company right now is unmatched. I'm proud of the foundation that we're building for the future, says Alex Chriss. And the important thing to remember about Alex Chriss and all these innovations they've been launching over the past few months here, just keep in mind, we're not even seeing that in these numbers yet. You'll begin to see that in 2025. 2024 was Alex Chriss' first full year being CEO of this company. So this was just a year of like getting everything in getting the right partnerships, getting the right products and services out there, innovating at a high level, getting the teams all focused on what they need to be focused on. But in terms of it actually showing up in the financial performance, you're going to really see that in 2025 and 2026. This was just get the ship point in the right direction, and then we start to see the fruition of all this hard work next year and in following years after that, okay? Now check this out. Active accounts grew 1% for the company. That's good because that was a number that was declining for a while, and people looked at it and they're like, oh my gosh, active accounts is going down. It's going up now. That's great, and that's off a very large number of active accounts, 432 million. Monthly active accounts grew at even a faster pace. That's even better news. Year-over-year growth, 2% for monthly active accounts to 223 million. That's phenomenal. It's one thing if you just have accounts, right? But it's like how many people are actually using this on a monthly basis. That's a very important number. One of the most important numbers you can look at for PayPal. Number of total payment transactions was up 6%. So let's get this right. Monthly active accounts was up 2%, but number of payment transactions was up 6%. And transactions per account was up 9% year over year. So what that means is people that are PayPal customers, you're using PayPal more and more often, which is something you definitely want to see. Total payment volume mix across PayPal's payments. This is when we begin to understand what's actually going on with PayPal's business, okay? So branded checkout was the same year over year, 6%, right? Really no difference there in the percentage growth. The absolute number is a lot bigger, but the percentage growth, no difference. But here's where the weakness is in PayPal's revenue. And if you're wondering why the revenue growth rate is not much stronger than it is, it's right here. If you look at unbranded card processing, okay? So this is non-PayPal. This is like more their Braintree side. Last year at this time, they had 32% growth. This current quarter, only 11% growth. Now, my personal opinion on that is the company's likely focusing on profitable growth. Remember, you hear Alex Chriss talk again and again about we're focusing on profitable growth. Not just growing revenue to grow revenue's sake, right? Like what good is it if you're growing revenue and you're not capturing any real profits off of that, right? And so that's my opinion on why this number was very weak compared to the past, is they're likely just focusing on, if it don't make money, it don't make sense, right? And I think that's the situation here. You look at Venmo, consistent growth rate, 8% last year, 8% this year. If you look at P2P x Venmo, right, they were down 4% last year at this time. Now they're plus 5%. So peer-to-peer is going phenomenal x Venmo. That's amazing, right? Other merchant services went from 6% growth to 16% growth, okay? Now, this is a much smaller absolute number, right? It's only 10% of revenue compared to unbranded card processing at 36% of the company's revenue. So the moral of the story is here, and by the way, eBay got a lot better. They went from negative 11% to negative 3%, right? So total payment volume of 9%. So the moral of the story is the revenue could be likely a lot better than it was if they just, were really, really focused on, making money for money's sake, basically having revenue just for having revenue's sake, right? But it looks like Alex Chriss is really focusing the business on profitable numbers, right? Things that actually change the bottom line of this company. Now, as far as the guidance, I thought the guidance was a weak guidance, okay? The revenue, low single digit. My guess is that has a lot to do with the unbranded card processing, right? Non-GAAP effective tax rate, approximately 21%. Non-GAAP EPS, low to mid-single digit, a decrease for the company on a year-over-year basis, right? Now, before they were expecting a mid to single digit decrease. So just keep that in mind, right? GAAP EPS, $1.03 to $1.07. The prior was $1.05, so that's basically what they're at. So as far as the fourth quarter goes, definitely a put me to sleep guide there. That's the one weak point, I would say, in regards to PayPal numbers. But if their unbranded card processing is in a weakened state because they're really focused on profitable growth, like I get it, right? But I would have loved to see, revenue of 8, 9, 10% in the fourth quarter. Now, transaction margin dollars, as far as the full year, fiscal year 2024, mid to single digit growth. Now, prior to that, they were at low to mid single digit growth. So this is better. Transaction margin dollars better than expected. Non-GAAP, non-transaction operating expenses, they were talking about low single digit growth. Prior was a slight increase here. Non-GAAP effective tax rate, approximately 21%. Prior was 22%, so a little better than expected. Non-GAAP EPS, high teens growth. They're talking about for non-GAAP EPS. Before they were at low to mid-teens growth, so that's better. GAAP earnings per share, $3.92 to $3.96. Prior guide was $3.88 to $3.98. So they're going a little bit on the higher end of the range. That's good. Free cash flow, approximately $6 billion. Share repurchase, $6 billion. No change from prior there. Now, check this out. Another strong quarter building upon the foundation for durable growth. Transaction margin dollars, excluding interest income, up 6%, driven by strength in branded checkout, Venmo, and Braintree. Braintree I feel like is a little in a weaker spot right now, right? Improving checkout with faster and simpler branded and guest experiences. Reinvigorating brand awareness and driving engagement with PayPal Everywhere and Venmo, enabling seamless experiences that enhance our flywheel via new partnerships and leaders in global commerce, raising our fiscal year 2024 transaction margin dollars and non-GAAP EPS guidance while investing in innovation and our brands. And the transaction margin dollar, that was the one thing that the bears could look at and be like, that transaction margin dollar is not good. It's in a bad place, right? You no longer have that argument to be made, right? The only thing the bears really ever had to go off of PayPal was active accounts going down there for a little bit, right? And transaction margin dollars being in a bad place. You don't have either of those to go off of now. The accounts are growing, right? And transaction margin dollars look in a great place and likely going to get into a strengthened place next year. So to be bearish on PayPal, it just doesn't make sense anymore. You either have to be kind of middle ground in regards to PayPal, like not really a strong, opinion either way, or you have to be bullish on the stock. There's just no being bearish. It doesn't make sense anymore, right? Now, additionally, cash equivalents, and investments totaled $16.2 billion for the company. Debt was at $12.4. So basically, with all the cash equivalents, and investments on the balance sheet, they could get rid of their debt completely if they want to, right? Now, they also returned $1.8 billion to stockholders by repurchasing approximately 28 million shares of common stock. On a trailing 12-month basis, they've returned $5.4 billion to stockholders by repurchasing approximately 87 million shares of the common stock, right? Now, keep in mind, PayPal should buy back between $3 billion and $6 billion of shares, likely, in my opinion, every year for years to go in the future. Years to go in the future. The share buyback we're seeing today is great. Wow, they're taking a lot of shares off the market, and it's really going to help the earnings per share. But just keep in mind, I think they're going to have an onslaught of buyback for years to go in the future of this company because they're able to spit off so much free cash flow. It's a free cash flow machine. It's an ATM of a company, right? So what are you going to do with all that money? They're going to reinvest a certain amount in the business, but they're also going to use a great deal of that to buy back shares, especially with shares trading in these low ranges in regards to P ratios, right? I mean, PayPal's been trading at forward P under market multiple. Like, that's crazy, right? Now, also keep in mind there's about an $85 billion market cap roughly on this company. So when you're buying back $3 billion to $6 billion worth of shares year in and year out for years to go in the future, and you're under $100 billion market cap, it's a good time to be a shareholder of this company. I can tell you that. It's a good dang time. Now, if I look at their income statement here, revenue is $7.8 billion versus $7.4 in the same quarter last year. Transaction expense, $3.8 billion versus $3.6, right? So up year over year, but it's not even up remotely close to as much as revenues were up. Transaction and credit losses fell significantly for the company year over year from 446 to 352. That's phenomenal. Customer support and operations, 427 versus 474. So they brought that number down by, we can call it roughly $50 million year over year. Sales and marketing, they're increasing that quite a bit. They're spending a lot on sales and marketing right now, right? Really branding PayPal strong in the marketplace, PayPal everywhere, commercials on TV, Will Ferrell, et cetera, right? And so certainly that's hurting the profitability right now, but that's all stuff that's going to help PayPal huge long term. Technology and development, they increased slightly in regards to that, not that much. If we look at general and administrative, G&A, 519 versus 507, slight increase there. That's nothing compared to how much their revenue was up, their revenue was up well over $400 million on a year-over-year basis. Total operating expenses, 6.4 versus 6.2. That's like nothing compared to how much revenue was up. So their operating income went to almost $1.4 billion versus $1.16 billion in the same quarter last year. So operating income booming for PayPal, booming. Now, the bottom line got hurt by a few kind of, more almost like one-off type things. Other operating income expenses. So they had an $80 million unfavorable one-off here expense that hurt profitability versus in the same quarter last year, they had a $73 million other one-off income, okay? So they made last year their basically the bottom line looked better than it probably should have been in the same quarter. This year it's going to look worse than it honestly should be because these one-offs are here and they're gone, right? Income before income taxes, $1.31 billion versus $1.24 billion in this same quarter last year. Income tax expense, they also had a huge increase in income tax expense to $301 million versus only $221 in the same quarter last year. So it made their net income look like it was down on a year-over-year basis, but really it comes down to these kind of more one-off freakish type things, right? The obviously the $80 million expense hit hard versus $73 million gain in that quarter last year. I mean, that's a $150 million, that's a $153 million difference there. It's not like that's a small amount of money, $153 million of a one-off there, right? And the income tax expense, they got obviously screwed in this quarter compared to last quarter. So the moral of the story is, like, PayPal, I graded them a B+, but honestly, this was, in the reality, if you take off this one-off here and you take off this freakish addition to income tax expense, honestly, this was like an A. This was like a grade, either an A- or a grade A income statement for PayPal. Like, bravo. Like, Alex Chris doing a hell of a job running this company. Additionally, check this out right here. If you look on a diluted basis, right, they had almost 1.1 billion shares outstanding, right? And now they got that share count down. Probably in the next quarter, they're going to have it down under 1 billion shares outstanding of this company. That's an incredible thing about it. So understand, when you're a shareholder of PayPal, you own more and more of the company. Like, let's assume you own the same amount of shares right now as you did at this time last year. Let's say you own 10,000 shares of PayPal, right? Last year at this time, you still own your 10,000 shares. You've become a bigger owner of PayPal over this amount of time now. And the reason being is because they bought back so many shares and expired so many shares that your percentage ownership has now increased. And as PayPal continues to buy back more and more shares and takes a share count, maybe let's say even under, they could take the share count under 1 billion shares very soon here, right? And then they might end up being able to take it under 900 million over the next couple of years, right? Whew. So if you just own the same amount of shares, you're a bigger owner of this company now. That's phenomenal, right? Now, Where's the stock price headed? It's $80 here today. The stock's headed to 100 plus. 100 plus, okay? 3 core reasons. 1, easy numbers coming quarter. Easy numbers. Like now they put themselves into a situation with this upcoming quarter. Those are very beatable numbers. Very beatable numbers. They really, in my opinion, sandbagged there, and they set themselves up for a very positive beat at the beginning of this year. Beginning of this year, meaning the beginning of 2025, essentially. So that's good, right? Second, Chris changes are really all going to start hitting in 2025. Like, we haven't even really begun to see that in a major way in the financials yet. That's going to be 2025 show, so just wait for that. And third thing is, the consumer should be in a better spot in 2025 than they were in 2024. Because remember, the consumer in 2024 came off of super high inflation in 2023 and 2022. The consumer in 2025 is coming off of 2024, where the consumer hasn't been hit nearly as hard with inflation. Inflation numbers have been very good all of 2024. So the consumer is set to actually bounce back pretty decent in 2025 as a whole versus where they were at in 2024, right? And that's going to definitely benefit PayPal in a pretty significant way. So this stock's likely headed to 100 plus. Was I buying the stock here today? Yeah, I was. I bought shares today. I bought shares at $80.96, 50 shares here. The stock's still a buy. It's a buy, and it's a buy. And it's going to probably remain a buy for a while, because even when the stock goes over 100, which I don't think is in too distant in the future, it's still going to be a buy. The valuations are still going to be so attractive because the buybacks are so big. The free cash flow is pouring in for this company. And then you got Chris changes really starting to hit next year. If you get a consumer in a better spot next year than versus this year, oh my gosh. Whew. Like, yeah, the numbers could be looking very, very good next year and in future years. So PayPal's getting positioned in a very good place. And so would I be surprised to see a 120 on this stock in the next 6 to 12 months? Not surprised at all. Not surprised at all. Things are going very good here with PayPal, okay? Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. Alrighty, let's check out this next one. A November Fed cut isn't necessary?
Around a 3-month high now. Investors looking ahead to this Friday's jobs report and what it might mean for the next Fed meeting. Joining me now to discuss, Richard Fisher. He's the former Dallas Fed president, the Jefferies senior advisor, also a CNBC contributor. Welcome. It's nice to see you.
Thanks, Scott. Thanks for having me. Appreciate it.
What are they going to do in this meeting after the election, you think?
I don't know, to be honest with you. I always think of what I would be arguing if I were sitting still at that table. And as was just pointed out by Tony and others, we have good economic growth at 3% or so, most likely in this quarter. Pretty full employment. Manufacturing continues to suffer, but there still is demand for services. So if I were sitting at the table, Scott, I would probably be almost arguing there's no need to do anything. We don't do it to satisfy the stock market bettors that are depending on every little bitty move. We have to realize that after the last 50 basis point cut, from the 6-month all the way out the yield curve on treasuries, rates are higher. You just pointed out the 10-year. It's also true for the 1 year, for the 2 year, for the 6 month, and the 30 year. So the question is, why is that happening? And as you know, I have my own theories about that, but I'm not sure it makes a difference, frankly, at this point. And I would probably be arguing, let's just settle in here. I'm willing to accept 25 if the rest of the committee wants to do it, but I'm not sure it's necessary at this point.
Well, what do you actually think the chances are of a pause either at the November meeting?
It makes no sense. No sense at all. The bottom line is the Fed is way too restrictive right now. Way too restrictive. Why would you want to keep Fed funds rate up here and risk putting the whole economy into a big recession, right? Doesn't make sense. You got to get cutting. You've got to skate to where the puck is going. The bottom line in regards to this. So you want to play this game of like, oh, everything looks pretty good with the economy right now. Like, we don't need to be in a rush. What are we talking about here? CPI is likely on its way under 2%. That's under where the Fed's expected. So why would you stay insanely restrictive when we're talking about a CPI that's likely going under 2%? And we got a Fed funds rate right now, 4.75 to 5? That just doesn't make sense. That doesn't make logical sense, okay? Listen to company earnings, right? The strongest are strong, sure. They're still performing well, but there's a lot of other companies underneath that aren't performing great, right? And remember, when we're talking about these companies that are reporting, this is a creme de la creme. When we're talking about these stocks that are public companies, remember, these are the top 1% of best businesses in not only the United States, but pretty much the world, right? And so, like, what's going on with like the bottom 50% of businesses or the bottom 70% or 80%, right? Because we always got to keep in mind small business is the key. Is small business feeling great? Check out the Small Business Optimism Index. Take a look at that sometime. That's really what you need to look at, not the strongest companies. If all you were looking at is Nvidia and Meta, the 1% of the 1% of the 1%, you got this game all wrong. And so the bottom line, you can't stay this restrictive for no reason, because that's what it is. It was staying this restrictive for no reason. The used to make sense to stay this restrictive when we had inflation that was completely out of control. But with the CPI that's on its way under 2%, what are we talking about?
Last one of the year. You're not the only one suggesting at this point that, you know what, maybe they only go one more time this year. Maybe they go next week and then they sit back and they just wait and see what happens.
That's possible.
I would expect another quarter sometime this year. It could be at either meeting. But again, for this meeting, I don't think it's necessary. There's still a lot of data that we want to see. And if you take an extra month or an extra 6 weeks, that's the way the clock works, it gives you more time to examine the data.
What data?
Is it?
What data? Look at anything you want to look at inflation-wise. You want to look at the PCE? Look at the PCE. You want to look at the CPI? Look at the CPI. You want to look at commodities and what's going on in the commodities market? Look at it. You can pull it all up. You got all the data in the world. You don't need more time for more data. What are we talking about here? This is why the Fed is always late in raising rates and lowering rates, because they just are never satisfied with enough data. And they look at it, and then it gets so over crazy in one area, and next thing you know, they're lagging big time, and they end up having to be forced into crazy rate cuts or crazy rate hikes. This is why. Like, this man is a perfect example of why the Fed cannot freaking skate to where the puck is going. It's unbelievable.
So because, I think what's being proven out.
How much more data you need?
I don't think I'm breaking any new territory with suggesting this, but the neutral rate's obviously higher than where they once thought.
Right.
By virtue of the fact that growth is as strong as it is. So they're not as restrictive as they probably thought they were, which gives them the luxury maybe of just doing that one you suggest and then taking their time to see what happens with the data. How would you assess that?
I would have a button at the table and just play what you just said. Financial conditions are still fairly lenient. Spreads, as you know, are narrow, even though the rates have risen. The credit markets are fairly flush still. We have a lot of private credit out there. And I think still, and look at the stock market, we are accommodative here. So what's the need to push on that string? I'm not sure.